Hi, it's Carol Roth for Goldline. Today I'm going to talk about whether the U.S. banking system is headed towards catastrophe. During a recent meeting with big bank CEOs, Treasury Secretary Janet Yellen reportedly said that more, quote, bank mergers may be required to stabilize the industry. It was also a big hint that the collapses and consolidations that have plagued larger regional banks may not be near an endpoint. But it's not just the smaller banks that are at risk. The big banks are contending with major issues as well, per recent reports from the FDIC and academia, creating the backdrop for a potential catastrophe. Now, one issue relates to uninsured deposits. Coming out of the Great Recession financial crisis, uninsured domestic deposits shrank as a percentage of overall deposits in the banking system. However, they shot back up again after a few years. A recent FDIC report shared that uninsured domestic deposits had increased to 43% of overall deposits by the end of last year. In dollar terms, that means that at the end of 2022, there was approximately $7.7 trillion in uninsured domestic deposits in the U.S. banking system. The piece also noted that, quote, the trend has been most pronounced among the largest banks, and that, quote, growing concentrations of uninsured deposits at large banks make the banking system potentially more vulnerable to depositor runs. Let me underscore that for you. The banks we believe are the most stable are being called out by the FDIC as having a larger percentage of uninsured deposits. They're projecting that not just the regional banks, but the largest banks are subject to depositor runs. Wall Street on Parade analyzed the big banks' year-end holdings and found that more than 40% of the uninsured deposits were held by the big four banks. However, when looking at systemic risk, the deposit side is only part of the story. The larger banks generally have more scale, better diversified business models, and may not have the same mark-to-market or paper losses of assets on their balance sheets, the latter which can create issues if they are needed to be liquidated early to pay back depositors who want to take their money out of the banks. But that doesn't mean that the big banks aren't facing issues. A study recently completed by professors from Stanford, Northwestern, and elsewhere found that across the banking system, assets, if marked to market, that is the estimated value they'd receive if liquidated today instead of being held to maturity, would be around $2.2 trillion lower than the value they're carried at on the bank's books. Again, it doesn't necessarily mean there's a problem if they're held to maturity, but it can be if they need to be liquidated and they're not hedged, which the study notes that most of the assets are not. In doing their analysis, they found that not only are a slew of banks at risk of a run that would make them insolvent, but one that they identify at risk is a bank with more than $1 trillion in assets, meaning one of the largest banks in the banking system. The implications are severe. Having large regional banks go under could cause shocks throughout the system, but having one of the major banks have a bank run would increase that probability exponentially. The issue here is really one of perception. If the public at large, including those with uninsured deposits and believing that the big banks remain too big to fail, has that confidence shaken, well, that could upend the entire banking system. The big banks also hold a substantial amount of foreign deposits outside the U.S. These are also not FDIC insured. While each local country might provide some level of insurance, this creates another potential risk that not many are focused on. I share all of this with caution. We certainly do not want to see the banking system implode or face serious chaos, and the more public concern, the riskier it becomes, as the system is very much built on faith. However, we also don't want to be caught flat-footed, given the clear issues that are pervasive throughout the system. As always, it is important to evaluate your accounts to ensure that you are within current FDIC insurance limits or NCUA limits if you are at a credit union, and also SIPC limits for securities that you may have within financial institutions. More bank chaos would be a catalyst for having more assets considered to be safe havens. That includes gold and other precious metals. I personally suggest physical gold, as paper gold has its own set of systemic risks. Now, if you haven't had an opportunity to hedge your own portfolio or haven't hedged enough, consider giving my friends at Goldline a call to help you. And do not wait on this. Those banks, they didn't hedge their exposure, so learn from their mistakes. If you call Goldline at 800-319-9533 or visit goldline.com, they have a special offer for their Betsy Ross Freedom Round, which was designed by me and is exclusively available through Goldline. With a qualified purchase, get 1 copper Betsy Ross Freedom Round for free with every silver one you purchase. That's 800-319-9533 or goldline.com. It's clear that much needs to be done to fix the banking system. Unfortunately, the government and the Fed have been the enablers of risk, so it's unlikely that they are going to be solving the issues anytime soon. Understand the risks this could cause for you personally and take urgent action now to protect yourself and your hard-earned wealth. I'm Carol Roth for Goldline. I'll see you next time. The views and opinions expressed in this video are those of Carol Roth and do not necessarily reflect the views or positions of Goldline or its parent company or affiliates. These views and opinions may have been previously disseminated in other media.